Okay, let's unpack this. Today we're diving deep into Dell Technologies. We've got their latest reports, filings, and we're basically cutting through the noise to get to what really matters. Our goal here is to distill the crucial insights, the stuff that tells you what's actually driving Dell's performance and strategy. Think of this as your shortcut to understanding one of the tech giants, without getting lost in all the jargon. You should walk away well-informed, maybe with a few surprises, and a clear picture of Dell today.
Yeah, and what's really interesting, I think, is how these filings give you that holistic view. It's not just numbers in isolation, it's the strategy, the market dynamics, even the culture, really, that shapes a company this big. We'll try to connect those dots from their basic operations right through to their social impact goals so you see the bigger picture, beyond just the headlines.
Right. So when you hear Dell, most people probably jump straight to laptops, maybe desktops. But this deep dive, it really shows they're positioning themselves as much more than that. So what's Dell Technologies actually setting out to do now in today's tech world?
Well, their core mission, it's pretty ambitious. They want to help organizations build their digital futures and also help individuals transform how they work, live, play. They talk about providing a broad, innovative portfolio for what they call the data and AI era that covers traditional and modern infrastructure. Their vision to be the most essential technology partner. That's a bold statement, aiming to grow their leadership and grab new opportunities.
Okay, most essential technology partner. And they break things down operationally, right? Into two main segments. Let's start with the first one. The Infrastructure Solutions Group, ISG. What's that all about?
Right. ISG, this is really about enabling digital transformation for businesses. It's focused on solutions for AI, machine learning, data analytics, multi-cloud setups. So that includes storage, servers, and importantly, that now includes both general purpose and those AI-optimized servers everyone's talking about, plus networking gear. Think of it as the engine room for modern enterprise IT. And an interesting geographic note, about half of ISG revenue comes from the Americas. The rest is EMEA and Asia Pacific, Japan.
Okay, so ISG is the big enterprise engine room. Then there's the Client Solutions Group,
Yeah.
CSG. What does that cover?
Yeah, CSG is the part most of us probably picture first. Branded PCs, notebooks, desktops, workstations, plus peripherals like monitors, keyboards, and also third-party software they resell. Their focus within CSG strategically is on commercial clients and the high-end consumer market. They see those areas as more stable, more profitable, compared to the lower-end consumer PC market, which can be very volatile.
That makes sense. But it does raise that question, doesn't it? How do they balance that traditional, maybe slower growth PC market in CSG with these newer high growth areas in ISG, like AI infrastructure?
That's the key strategic challenge, absolutely. How do you manage both? And beyond just selling the box, they have different ways for customers to actually get these solutions right, not just buying outright.
Yeah, tell us about that.
Right. So besides the standard purchase and financing through Dell Financial Services, which we'll touch on later, they're really pushing flexible consumption models. Think utility models, subscriptions as a service offerings. These let customers pay over time based on usage sometimes. It gives them financial and operational flexibility. And for Dell, it means potentially more predictable recurring revenue, which investors tend to like.
Okay, that sets the stage nicely. Let's get into the numbers then. How did Dell actually perform financially in their fiscal year 2024 that ended back in February 2024?
Well, the headline figure, overall net revenue, was down 14%. It landed at $88.4 billion. And that drop was driven by declines in both CSG and, to a lesser extent, ISG as well. If you break it down, product net revenue fell 19%. But here's the interesting part. Services net revenue actually grew by 4%.
Up 4% on services, even as products were down.
Exactly. So even though the top line shrank, that services piece showed some real resilience, a bit of a silver lining there, showing a potential shift in their revenue mix.
Okay, revenue down overall.
Yeah.
What about profitability? Operating income, net income, what's the story there?
Operating income was down 10% to $5.2 billion. Their non-GAAP measure, which they often highlight, was down 11% to $7.7 billion. And the reason was pretty straightforward. The revenue decline basically outpaced the benefits they got from lower component costs and their own cost-cutting efforts. But, and this is key, their operating income as a percentage of net revenue actually went up slightly by 30 basis points.
How does it work? Revenue down, but margin percentage up.
Because their gross margin percentage improved. Lower input costs, things like memory and panels got cheaper. So even on lower revenue, the profit they made on each sale, relatively speaking, was a bit better.
Got it. But here's where it gets really interesting, as you hinted earlier, the cash flow situation.
Yes. This is probably the standout metric for the year. Cash from operating activities was $8.7 billion. That's up a massive 143% from the previous year.
Wow, 143% increase.
Yeah. And free cash flow, which is basically operating cash flow minus capital expenditures, that shot up an incredible 935% to $5.9 billion.
900%. How does a company manage that when revenue is falling?
It comes down to a few things. Profitability still contributed, even though it was down overall. But the big drivers were really strong inventory management. They brought their inventory levels down significantly and just being very efficient at collecting cash from customers. It shows really tight operational control, turning those sales, even fewer sales, into actual cash much more effectively.
That is a fascinating contrast. So digging into those segment declines a bit more, why was ISG revenue down 12%?
For ISG, it was mainly declines in servers and networking and a bit in storage, too. They pointed to the global macroeconomic conditions, businesses being cautious about big IT spending, demand was just softer.
And CSG, down 16%. Was that just fewer PCs sold?
Mostly, yes. Fewer units sold in both commercial and consumer. However, an important detail. The average selling price, or ASP, for their commercial offerings actually increased. They said this was due to customers choosing richer configurations, meaning higher spec, more expensive machines, and just a different mix of what they sold. So fewer units, but leaning towards higher value ones, at least on the commercial side.
Okay. Richer configurations helping offset some unit decline.
Yeah.
Now, shifting gears to strategy again, there was big news concerning Dell's relationship with VMware. What happened there?
Right. So Dell spun off VMware back in November 2021, but they kept a close relationship, reselling VMware products under a special agreement, a commercial framework agreement, or CFA. Then Broadcom bought VMware, closing the deal in November 2023. And Broadcom announced pretty significant changes to how VMware products would be sold and licensed. As a result of those changes, Dell decided to terminate that CFA. They gave notice in January 2024, and the agreement ended in late March 2024.
So the formal reselling agreement is over. Does that mean they stopped selling VMware altogether?
Not entirely. Dell said they'll continue to integrate and sell select VMware products and services. So it's not a complete break, but it's definitely a major change in that partnership structure. It moves from a very tight, formal agreement to something more selective.
Okay, a recalibration there.
Yeah.
Now, thinking about actually making all this hardware ISG and CSG products, what does their manufacturing and supply chain look like? You mentioned potential risks earlier.
Yeah, they operate globally. They have their own manufacturing facilities in places like the US, Malaysia, China, Brazil, India, Poland, Ireland. But they also rely quite heavily on contract manufacturers around the world. That gives them flexibility and helps manage costs. The potential vulnerability, though, comes from their reliance on what they call single source or limited source suppliers for many components.
Meaning only one or maybe two companies make a specific chip or part they need?
Exactly. And while that can have benefits, maybe better pricing or specialized tech, it's a big risk if that supplier has problems or if demand suddenly spikes. They specifically mentioned this challenge with AI-optimized servers where the demand for GPUs, those powerful graphics processors, has outstripped supply, leading to higher backlogs. They do emphasize quality control, ISO certifications, and all of that, but managing that complex supply chain with key dependencies is a constant balancing act.
Makes sense. And you mentioned Dell Financial Services, DFS, earlier. How significant is that part of the business?
It's actually really crucial. DFS provides and arranges financing for customers buying Dell gear globally. They originate loans and leases, manage the receivables. In fiscal 2024, they funded $8.4 billion in new financing. Their total portfolio is around $10.5 billion. So it's not just a side business. It directly supports sales by making purchases easier for customers, offering that payment flexibility, and it helps build those longer-term customer relationships. It's a key enabler for their sales engine.
Okay, so DFS is important strategically. Now, another thing investors always watch, returning capital to shareholders. What's Dell doing on that front? Dividends, buybacks.
They have a pretty clear strategy here. Return capital via dividends and share repurchases, but also invest in growth and keep their investment-grade credit rating. For fiscal 2024, they paid a quarterly dividend of $0.37 per share. And looking ahead to fiscal 2025, they announced a 20% increase in that dividend up to $0.445 per share per quarter.
A 20% hike. That's pretty substantial.
It is, and they're active on share buybacks, too. They authorized an additional $5 billion for repurchases in October 2023. As of their latest report, they still had about $5.7 billion remaining under that authorization. So they are definitely focused on returning cash to shareholders.
Which shareholders usually like, obviously.
Yeah.
But it does raise that question, balancing that return with the need to invest heavily in areas like AI, right?
That's exactly the tension. You want to reward shareholders, but you also need to fuel future growth, especially in fast-moving competitive areas. Finding that right balance is key for their long-term strategy.
Speaking of competition, let's talk about the landscape Dell operates in. What are the big competitive pressures they face?
Oh, it's intense. It's a rapidly changing industry. They face strong competition on both product features and price. This comes from the traditional IT players, other hardware and software companies. But increasingly, it also comes from non-traditional sources, especially the big cloud providers, the infrastructure as a service or IS companies. They offer alternatives to buying your own hardware, so Dell constantly has to prove their value, offer solutions that are scalable, integrated, have the right features, and are priced competitively. It's a tough environment.
Yeah, no kidding. And layered on top of all that is the constant threat of cybersecurity issues. How is Dell tackling that? It must be a huge undertaking for a company their size.
Absolutely huge. They handle massive amounts of sensitive data, our customers, and they face very sophisticated threats, including, as they mentioned, from nation states. These aren't just random hackers. They have a dedicated global security and resiliency organization led by a chief security officer who reports up to the general counsel. Cybersecurity risk isn't treated as just an IT problem. It's integrated into their main enterprise risk management framework. And importantly, the board provides oversight through the audit committee. They meet quarterly to review incidents, strategy, progress. It's a very structured approach, but they're also realistic, acknowledging that, no system is ever completely impenetrable.
Right, a constant battle. Shifting to a broader view, Dell has some pretty ambitious ESG, environmental, social, and governance goals set for 2030. Can you break down those pillars for us?
Yes, these 2030 goals are quite prominent in their reporting. They're built around four main pillars. First is advancing sustainability. This covers climate action, moving towards a circular economy, reducing waste, using sustainable materials. Second, cultivating inclusion. This is about workforce diversity and inclusion. They have specific targets here, which is interesting. By 2030, they want 50% of their global workforce and 40% of their global leaders to be women. And in the U.S., 25% of the workforce and 15% of leaders to be Black, African American, or Hispanic Latino. Setting public targets like that is quite a commitment.
Those are very specific goals. What are the other two pillars?
The third is transforming lives. This uses their tech and scale for positive social impact, things like advancing human rights, improving digital access and literacy. And the fourth pillar is upholding trust. This is the foundation focusing on ethics, integrity, privacy protection, responsible business practices. Taken together, these goals show they're thinking about their role beyond just profits and products. It's becoming part of their brand identity.
It seems increasingly important for companies, especially in tech. Okay, one last area, and it's something maybe not everyone thinks about, but it's crucial. Corporate structure and control. What's the situation at Dell regarding ownership and voting rights?
Yeah, this is really fundamental to understanding how Dell operates. They have a multi-class stock structure. The Class C shares, which are what most people trade on the stock market, get 1 vote per share, but there are also Class A and Class B shares, which get 10 votes per share. And as of March 2024, Michael Dell himself, his family trust, and funds associated with Silver Lake Partners, their longtime private equity partner, together controlled stock representing about 94% of the total voting power.
94%. So essentially they control the company.
Pretty much, yes. They effectively control shareholder votes, director elections, major decisions like mergers or acquisitions. This structure makes Dell a controlled company under New York Stock Exchange rules. That means they're exempt from certain governance requirements, like needing a majority of independent directors on the board. It allows for long-term focus, perhaps less pressure from short-term market demands, but it also concentrates power significantly.
That's a really important point about how the company's actually Run. Okay, just briefly, any other notable legal or regulatory items mentioned in their recent filings?
Yes, a couple of things. They mentioned receiving a subpoena from the SEC back in February 2024. It relates to transactions involving related persons, specifically around the use of corporate aircraft. They stated they're cooperating fully. They also noted, as many large companies do, ongoing IRS audits for past tax years, and they flagged the potential for a material impact depending on how uncertain tax positions get resolved. So, standard procedure in some ways, but those items are on the radar.
Okay. Wow, we've covered a lot of ground there. From the core business, the ISG, CSG, that surprising cash flow story despite lower revenue.
Right, through the VMware shift, the supply chain complexities, the capital returns, ESG goals, and that really crucial ownership structure.
It really paints a picture of a tech giant that's, well, still evolving, isn't it?
Yeah,
Managing legacy businesses while aggressively pushing into new areas like AI.
absolutely. It highlights that constant need to adapt, managing the supply chain, navigating partnerships like the VMware one, making those big bets on AI servers, all while keeping financials solid, especially cash flow and returning capital. It's a complex balancing act.
So, thinking about our listeners, what does this all mean for you? When you're looking at the tech sector or maybe even your next purchase, it's worth remembering the complexity behind these companies. It's this whole ecosystem of innovation, supply chain risks, changing customer demands, and that growing pressure for responsible practices. It's so much more than just the device in the box.
Yeah, and it really prompts a bigger question, I think. For Dell and others, when your traditional core products might face headwinds, what's next? What are the business models, the services, the strategic moves, maybe around AI, maybe those flexible consumption models that will define success for the next decade? Keep an eye on how companies like Dell leverage those things to pivot and find new growth. So after hearing all this, what really stands out to you?